Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Dana Lyons. We're going to be focusing more on the broad markets and a bit of a leadership change that Dana sees occurring within these markets, more in, I guess, the short to medium term. Dana is a fund manager and editor of the Lionshare Pro website. I'll post a link to the Lionshare Pro in the show notes. One other thing we should note is that Dana is running a current sale on a membership to the Lionshare Pro website. I recommend checking that out, clicking the link below, and signing up so you can stay up to date with Dana to keep your active portfolio management active in these markets, taking advantage of the opportunities he sees. Now, Dana, as we were briefly chatting off mic, look, not a whole lot has changed in the markets from when we chatted just a couple weeks ago, but more of a big picture theme that you are seeing is a leadership change developing within these markets. We all know how much the Magnificent Seven have led the sector and held the markets up. What leadership change are you seeing that's occurring right now?
Yeah, sure. Thanks, Corey. It's kind of interesting, and we did touch on it a little bit last time. Like you said, it's not much has changed in the last 2 weeks, but I think a key dynamic that we're focused on that I think investors should be focused on. And as you mentioned, we had the leadership of the Magnificent Seven, and then you had everything else. Now it's kind of flip-flop where you have the Magnificent Seven. I think there's still risk there, still risk in mega cap tech and semiconductors following that correction that started in July. Should get maybe another wave down. And now you're seeing strength in almost everything else across the market. And in particular, of importance is the broad market. You're seeing breadth is firm. You're seeing the mid caps bounce back pretty firmly. Value stocks are back, holding up well, and some of the equal weight indicators back at new all-time highs. So you're seeing strength there, even as the former leaders, the Mag 7, the techs, kind of fall by the wayside. So it would be really discouraging if we saw that correction in tech and the Mag 7 and didn't see money move somewhere else. But that's not what we're seeing right now. We do see major danger down the road a bit, but for now, our data, our models are still pretty firm. Never did actually turn negative during that late July sell-off, and now most of the indicators back in step on the positive side. So pretty constructive, but we do certainly have a sense of risk in that tech and semiconductor sector. So we do have some hedges on there, but a broad array of long positions as well.
Well, Dana, it also sounds just like a healthier market overall if the tech correction has led to a widening out of breadth and other sectors that were laggards starting to play catch up. I want to hone in on the value sector, though. You brought that up. Things like healthcare, real estate, REITs, some of the utilities. There's some different aspects of it that have gotten a bid. Obviously, even the precious metals has gotten a bid. Do you think that's a good way for investors to also hedge future risk by being in the value or maybe even consumer staples, something like that, where you're in a value sector that's catching up, but maybe not exposed to the pullbacks and some of the other stocks that have maybe gone up a lot higher already?
Yeah, I would say definitely as long as those sectors are performing. So I wouldn't hedge against tech sell off with other sectors if I don't think they're performing well. Also, I would hedge by shorting them. But at the same time, as you mentioned, money has rotated into those other sectors. So you like the value names, some of the defensive names, like you mentioned, healthcare, utilities, REITs, certainly well positioned for further upside there. So that is definitely a great hedge to have on right now if you're going to be short the tech stocks because they are moving higher. They are hitting new rally highs or new all-time highs. So we are not opponents necessarily diversification for diversification's sake, but we do like to diversify if those areas, if the positions we're taking are moving higher, are in uptrends, and do look strong to us. And really, all those sectors do look good. Value is coming back into play again versus growth. So I am encouraged by that and the broadening out of the market, like you said. I will mention this kind of the strength in the defensive names can be kind of a late cycle type of phenomenon. So it could be an early warning sign that this bull market might be on its last legs, or at least have your antenna up for that. But right now, we're very much in ride it. As long as it continues to perform, we'll be riding it. Our portfolio will be riding it.
So if this rotation continues the way you're seeing it, people can make money in these individual sectors. What does it mean for the broad averages? Could the broad averages more or less trend sideways, or are they still very much in uptrends from what you see?
Yeah, a lot of the broad averages have kind of been trading sideways since really the last 4 months, 4 or 5 months or so. We saw some consolidation there after the first quarter when we saw in the second quarter the Mag 7 and the semiconductors and whatnot really take off and start flying higher. We did not see with that move coincident new highs in those broad indicators, which was a bit of a concern, and that perhaps led to that pullback in July into August. But we pretty much we saw that broad market, even in that correction, the broad market held up pretty darn well and has bounced right back up towards the top of the range. Or in some instances, we are seeing new highs, like the equal weight S&P 500 has gone back to new highs, which is a great sign. Look at the NYSE advanced decline line, a huge broad measure of participation that's back at new all-time highs. So you are seeing the broad market either already moving to new highs, which is great, or consolidating in a nice tight fashion, setting up another breakout and a new move to new highs, which I think is on tap either soon or perhaps after another hit maybe in the tech sector. We've been looking for a C wave down, maybe retest those prior lows, at least in that sector, which might correspond with another kind of pause in the broad market before we really take off and break out on a sustainable basis. And another thing that would play into that latter scenario would be the fact that we're entering September, which is historically a rough month for stocks, really the only month with a solidly negative average return. So that would argue for maybe kind of not quite yet ready to break out signal for the broad market, but I think it's coming for sure.
Dana, are there any sectors other than the weakness you've already noted in tech? Are there any other sectors of the market that you're flat out avoiding or even shorting?
It's tech, semiconductors, mega caps that had led the way. We would be leery right now of Japan, which really, had a tremendous couple of years, really, and was one of our best positions for a couple of years. That really, I think it got overowned and got too much attention. And so kind of sold off in a similar fashion as the tech really got battered, has bounced back. I think there's risk there right now in the intermediate term or short term. We do really like Japan in the longer term. It might just take a little bit after a couple of years of run, it might take some consolidation before that next wave up. But those would be the main areas we're either avoiding or hedging in.
So, Dana, you said that sometimes the move into defensive sectors is late cycle for markets. Look, this has been a great bull market run after that very quick collapse during COVID. How do you time something like this, though? If you are seeing all these opportunities, but it could be late cycle behavior, which some people would attribute to a broader market correction, maybe even a market crash, how do you go about timing this?
Yeah, so that's kind of anecdotal, a signal like that, and longer term, when it comes to decision making or investment making decisions, we always fall back on our models and our signals, which are, as we mentioned in the past, really on an intermediate term basis, which is for us kind of on a 2 to 6 month spectrum typically, but on the order of months for sure. But we'll fall back on our quantitative models to specifically time those signals and time those junctures where, okay, it's time to pull your horns in or get defensive or outright short. But as I mentioned in the past, a lot of our model inputs come from breadth, come from market internals, come from those broader signals. And right now, like I mentioned, those signals are strong. Breadth is good. The internals are good. The broad market measures are good. So you could have late cycle sector leadership But if the broad averages, the broad signals are still firm, I don't really have that much concern yet about kind of a broader market correction or a broader bear market just yet.
Dan, let's also get your thoughts really briefly on the precious metals complex. And are you looking at silver differently than gold and silver stocks differently than gold stocks?
Yeah, they're lagging a little bit, and gold has really been, even just from a chart or technical basis, gold has really been a lot more attractive for us in recent years as it's been able to hit higher highs, higher lows, which silver hasn't really been able to do. Silver kind of tends to be a higher beta play within those short-term moves, but scrolling out or zooming out, gold is able to move to all-time highs, hit those higher highs even on a longer term basis. So we do definitely have more of a bigger position, more confidence in gold and even the gold miners, but we do have positions in silver and to a lesser extent silver miners. But just from a pure technical read, I think gold is still a better play than silver. I would say looking at the GLD chart, we are approaching what might be a pause juncture up around that 240-ish level in GLD would be that 161 extension, fib extension from that post 2011 decline, which might be illogical, might be a reasonable target or spot to expect maybe some consolidation. Gold has not historically run away and or just run straight higher. Like most commodities, they're more constricted within a band, unlike the stock market. So I would say we'll probably pull our horns in a little bit around that 240 level in case we do get some sort of consolidation or pause there.
Dana, would you consider looking at some leveraged gold ETFs to play that stronger gold market again before maybe it gets to some of the levels that you think it could top out at?
Yeah, if we're trading, we use leverage products mostly most of the time to hedge because we don't have those hedges on for longer periods of time where just the construction of those leverage products creates the decay or kind of a chop where over time you lose money on that. So it's really a trading product, and I would really advise listeners out there, if you're going to use those products, it's really on a trading basis only. It's not a buy and hold product. It's not a short and hold product, but we do use them mostly on the short side if we're looking to hedge ourselves. On the long side, don't generally use it because again, our longer positions, no pun intended, tend to be longer in duration. We tend to hold them longer for a longer period, and don't want to put up necessarily with that decay if we think there's a chance of that the trend could persist for months or even up to a year. So that's generally how we use leverage products.
Dana, any other commodities that you're playing from the long side? I know in the past we've talked about uranium, copper, oil. Anything else that you like from a bullish position?
Copper's been obviously, I talk about silver lagging gold. Copper's really been lagging even silver. So we've got a small position on there. Uranium, you and I have talked in the past. We were more constructive on it, had kind of a breakdown within the recent correction. And in the recent bounce here over the last really week or so, we did sell the rest of our uranium position. So no position there currently. A lot of the commodities are kind of range bound still right now. So gold is especially really the standout that we see right now. So we don't have a lot of commodity exposure right now. We are still leaning towards the narrative that we are more in a longer term upcycle for commodities. I think we just need to see some more technical evidence to put our money where our mouth is, and I don't see that right now.
All right, Dana, we'll wrap it up here. Again, Dana, Lyons fund manager and editor of the Lyons Share Pro website, which is currently running that sale that I mentioned. So click that link in the show notes, check out the Lyons Share Pro, and sign up for Dana's service. It's well worth it for all of you active traders out there that are managing your own portfolios. Dana, thank you again for your time. It's great chatting with you.